Interest rates could reach as high as 5% by the end of the year. Judo bank economist Warren Hogan believes sticky inflation will force the RBA to lift the cash rate in August, September and November. And he joins me live now. Warren, good afternoon. How are you?
I'm good, thank you, Janie. Thanks for having me on the show.
Absolute pleasure. Thank you for coming on this Sunday. But we want you to be wrong. Well, many of us do, don't we?
Yeah, look, we do. And the RBA was hoping that we wouldn't get to this point. And look, there is still a chance they might not have to raise rates. The economy is showing some sort of signs of recovery this year, and that's not good news. It's actually, we need the economy to remain soft because it has to be soft to get that inflation all the way down. And of course, if it starts to look like it's picking up again, that's going to compromise that process, the so-called narrow path the RBA has outlined, and it may lead to further rate hikes. It sort of seems to be where we're going, but the next couple of months will be critical.
All right, because I believe you were the only economist to predict the 5 interest rate hikes to 4.35%. So, yeah, I mean, we just have to wait and see, don't we? But it's not going to be great news for many people.
No, look, there's going to be a lot of pressure brought to bear on a segment of our community that's already under pressure, which is people with large mortgages versus their incomes. The servicing of that mortgage has already gone up massively in the last 2 years because of these rate hikes. And even just a couple more may push some people sort of over the edge. So far, actually, people have held onto their mortgages. The default rates and things that are coming through from the banks on distress are pretty low. But I've got a feeling that might change if we do see a couple of rate hikes. More broadly, though, some people benefit. And of course, I wouldn't see these rate hikes as a trigger for recession or a major downturn in the economy. It's all about actually keeping the economy on a sustainable path, which of course will mean some softness and a period where unemployment might go up a little bit. But I think we will get through this without recession.
And what kind of impact do you think the stage 3 tax cuts will bring?
This is one of the complicating features because it's a big boost to household incomes or disposable incomes. It's about 23 billion of extra money in the economy. And because the government's rewired it for everyone when the original plan was to mainly have the middle to top end benefit, it's likely to be spent. And again, it's this sort of point in the economic cycle where good news is actually bad news for interest rates and inflation. So if people get that money and spend it, that's just going to be another factor giving the economy some momentum and making it harder to get that inflation down.
And what are you going to be looking out for in the May budget?
I just think the government has to stick to what they've been doing, and that's being disciplined. That's allowing these extra revenues they're getting from income taxes to flow through, use it to pay off debt. Don't sort of go out there and spend a lot of money, although it sounds sensible that the parts of our community that are really hurting, lower middle income earners, need some support on this cost of living crisis. But the reality is it just complicates the RBA's job and makes it more likely they have to put up rates more. So they need to stick to their guns, stay disciplined, don't go throwing money around, let the surplus flow through. That's going to be the challenge ahead of an election where they're going to be very tempted to want to throw some money at our economy, and it's just not the right play.
And insurance premiums, we're seeing them go up, certainly with a lot of natural disasters and so forth. And we're also hearing many people are forfeiting their insurances, whether it's house health insurance. Is that a good idea?
Look, it's not. And it's a sign of this pressure that's on household budgets. And of course, insurance is one of those big domestic inflationary points. They're up 16% in the last year. I think up 4% or thereabouts in the March quarter alone, according to the ABS figures last week. So this is a pain point, and it is a sort of an easy to have without, take a bit more risk yourself. But I think it's all about trying to work out, well, what are the broad settings? Have I got too big a mortgage? Is this the right house to be in? I'll be careful on going short on getting out of too much insurance, because that could really hurt some stage down the track.
And I mean, we've seen, pretty strong markets in terms of house prices at the moment. This is certainly something people are going to be thinking about with these potential interest rate hikes. Is it a good time, do you think, for many people to be looking at selling potentially?
Well, this is, I think, where we could get to if we do see two or three more rate hikes. And the reality is that the housing market is still turning over. There's still lots of buying and selling going on, and prices are at or near record highs. So, if this level of interest rates and if the mortgage you currently have is too high for you to pay that mortgage repayment each month, it's not a matter of hoping interest rates will come down, because we're in a new higher level of rates going forward. And if we get a few more now, that just reinforces that. So, this isn't a bad market to be selling into. It's a much better market than, if no one was out there buying and house prices were falling, which I think could actually happen next year. So now's a good time to people to make some really cold, hard decisions about their financial position.
Because, I mean, looking even further past, say, a year, as you just mentioned, the interest rate hikes, but are we going to get down to those record lows at all, like down to, what we saw through COVID, for example?
We aren't. We aren't. Those days are long gone and will never return. I mean, the only way we're going to get interest rates back to, well, the RBA rate back to near zero is in an absolute economic calamity, which none of us want to see that. We've had a big turning point in inflation, and this is going to mean interest rates are higher for longer. This is the reality that the markets and investors are dealing with, and it's a reality that all of us in our community have to, for good or for bad. So we will eventually see some interest rate relief, and if they do hike this year, I think they'll be cutting next year. But when they cut, they'll probably only cut down to the current level, or maybe 3.5. We're not going anywhere near those lows before. And that's why it's important for people to make some pretty tough decisions in the cold, hard light of day about what this means for them over the next 3 to 5 years.
Yeah, good points. And what are you looking at overseas?
Well, the overseas story is actually really pushing us in this direction. What we're seeing in the United States is their economy's picking up steam and their inflation's picking up. Now, we're about 6 months behind them, and this is the last thing the RBA or any of us want to see. This is the risk that has to be mitigated and has to be addressed, and that is that inflation really picks up again and the economy picks up. That's what happened in the late 80s. That's what led to a 17.5% cash rate. Now, we're never going to get anywhere near that in this world, but we don't want to see the cash rate go up to 6 or 7% in the next few years. But they're the hints being thrown out of the US economy at the moment, and I think that's an important reason why the RBA needs to nip this in the bud, and a couple of rate hikes might do that.
Warren Hogan, thank you so much for your time and expertise. Enjoy the rest of your Sunday, and happy birthday for May the 4th. Be with you.
Thanks, Jody. Thanks for having me on.
Thanks, Warren.